Timing is everything. In the exciting world of investing, timing is everything. Imagine you're buying your favorite smartphone. You wouldn't buy it at full price, right? You'd wait for a sale or a discount. The same principle applies to investing in mutual funds. Mutual funds are like baskets of stocks or bonds. They allow you to invest in a diversified portfolio of assets with just one investment. Timing your entry and exit points strategically can significantly impact your returns. Just like you wouldn't buy a phone at full price, you shouldn't buy mutual funds when the market is at its peak. Instead, wait for market corrections or dips, which are like sales in the stock market. These corrections present excellent buying opportunities. By mastering the art of timing, you can buy low and sell high, maximizing your investment returns. So, let's dive deeper into the world of mutual funds and explore how to time your investments for maximum profit. Demystifying mutual funds. Mutual funds are investment vehicles that pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. Think of them as baskets of investments managed by professionals. Investing in mutual funds offers several benefits, especially for young investors. Firstly, they provide instant diversification, reducing your risk by spreading your investments across various assets. Imagine owning small pieces of many companies instead of putting all your money into just one. Secondly, mutual funds are managed by experienced fund managers who make investment decisions on your behalf. This professional management takes the guesswork out of investing, allowing you to focus on your financial goals. Lastly, mutual funds are highly accessible, even for small investors. You can start investing with relatively small amounts, making it an ideal choice for young individuals starting their investment journey. Mastering the art of timing. Timing your entry and exit points is crucial for maximizing returns in mutual fund investments. While predicting the market with 100% accuracy is impossible, understanding market cycles and trends can significantly improve your timing. One effective strategy is to invest systematically through a systematic investment plan, or SIP. With SIP, you invest a fixed amount regularly, regardless of market fluctuations. This disciplined approach averages out your purchase price over time, reducing the impact of market volatility. Another strategy is to look for market corrections or dips. These are periods of decline in the stock market, presenting excellent buying opportunities. When the market falls, stock prices become more attractive, allowing you to buy more units of a mutual fund for the same investment amount. Conversely, when the market reaches new highs, it might be a good time to consider booking profits. By selling some of your units, you can lock in your gains and protect your portfolio from potential downturns. Section 4. Riding the market waves. Seizing opportunities in corrections. Imagine the stock market as a roller coaster. It goes up, it goes down, but the overall trend is upwards. Market corrections are like those sudden dips in the roller coaster ride. They can be scary, but they also present golden opportunities for savvy investors. Let's say you want to invest in an equity mutual fund. The market is currently experiencing a correction. The news is filled with negative sentiment, and many investors are selling their holdings in panic. This is where you see an opportunity. Instead of joining the panic selling, you recognize that this correction is temporary. You start investing small amounts regularly through SIPs, taking advantage of the lower NAV, net asset value of the fund. As the market recovers and the NAV rises, your investments start generating profits. By timing your entry during a correction, you bought low and are now poised to sell high when the market rebounds. Section 5. Time your move, multiply your returns. The power of timing is undeniable in mutual fund investments. By strategically timing your entry and exit points, you can amplify your returns significantly. Consider this. Investor A invests a lump sum amount at the peak of a market cycle. Investor B, on the other hand, invests the same amount gradually through SIPs during a market correction. When the market recovers, Investor B, who bought units at lower prices, will experience higher returns compared to Investor A. This difference in returns highlights the importance of timing in maximizing investment growth. Remember, the goal is not to time the market perfectly, but to time your investments strategically. By understanding market cycles, using SIPs to average out your purchase price, and seizing opportunities during corrections, you can significantly enhance your investment returns. Section 6. The power of compounding. Start early, stay invested. One of the most powerful allies in your investment journey is the magic of compounding. Compounding is like earning interest on your interest. The earlier you start investing, the more time your money has to grow exponentially. Imagine two friends, both wanting to save 1 crore rupees by the age of 60. Friend A starts investing 5,000 rupees per month at the age of 25. Friend B, however, delays investing and starts at 35, investing 10,000 rupees per month to catch up. Despite investing double the amount, Friend B might still fall short of the 1 crore rupees goal due to the lost decade of compounding. This highlights the importance of starting early. Even small investments made consistently over a long period can create significant wealth due to the power of compounding.